Hi, it's Jim again. This video is the second video of a three-part series on investing. In this video, I want to show you how building an investment portfolio is not rocket science and that the process is easier than you might think. Building a portfolio, like most things, starts with a plan. If you think about it, a plan gives you direction. I see too many people who don't have a clear plan. I call this the wing it strategy. So many people have no idea if they're really doing the right thing. They have no idea if they're on the right road or not. If you think about it, building a portfolio is kind of like building a house. First, you need a set of plans. You also need some different parts and materials. And then there's a process to assemble these parts. Follow the steps and you'll build that house. Miss a step and you could have trouble. When it comes to the importance of building a plan, I think Warren Buffett, one of the most famous and most successful investors of all time, said it best. To be a successful investor does not require stratospheric IQ, unusual business insight, or insider information. What's needed is a sound intellectual framework for keeping emotions from corroding that framework. Basically, what Warren Buffett is saying is you need a plan to keep yourself from making psychological and emotional mistakes. Developing an investment plan is easier than you might think. You really just need to follow a three-step process. The first, investing is personal. So the first step is to take some time to understand what you want from your portfolio, what you need from your portfolio. The second step is to develop a mix of asset classes based on those personal needs. Some experts have argued that this step accounts for 90% of your investment return. We'll talk more about this later. And thirdly, you then have to select the appropriate investments that fit into the mix. One of the problems I see is too many people start with the investment selection before looking at asset mix and their personal needs. And as you can see, this is backwards. Understanding your personal investment needs can get quite detailed if you want it to. However, the starting point is to complete a risk profile questionnaire. Every company has their own version of these questionnaires, and it really doesn't matter which one you use. Once you finish answering the questions, the next step is to tally up your results and match them to the appropriate model portfolio. As a standard, the investment industry has 5 model portfolios based on risk. The conservative portfolio is the most conservative and generally recommends about 80% in fixed income, safer investments, and 20% in stocks or equities. As you move up the risk spectrum, you will allocate more and more equities to the portfolio. The most aggressive portfolio is typically 100% equities. These portfolios are not arbitrarily created. They're really based on what we call the science of investing, otherwise known as modern portfolio theory. Modern portfolio theory was pioneered by Harry Markowitz, and it suggests that you can optimize risk and return by mixing different asset classes together. Diversification is a real key concept in the investment industry. But there is a difference between inefficient diversification and efficient diversification. As you can see from this chart, you can have 5 different investments and they can all do the same thing. You'll still feel the ups and you'll still feel the downs of the market. The point of modern portfolio theory and efficient diversification is to mix these different asset classes that do different things at different times, which will reduce the overall risk and optimize returns. Once you've completed the questionnaire, you'll be directed to the appropriate asset allocation model based on your personal risk tolerance. Let's take an example of someone who should be in a balanced portfolio. At this point, you can use the suggested mix, or you can always alter it a bit as you desire. Remember, this is about building your own portfolio the way you want to. But remember, there's something to be said about the science of investing that has stood the test of time. Once you've looked at yourself and you've developed a mix, the third step in the process is really selecting the best investments that fit into that mix. When it comes to selecting investments for your portfolio, I can offer you 3 tips or 3 ideas. First, we want to talk about performance. How much does past performance actually indicate future performance? We want to look at the difference between active and passive investments, which is better. And you want to be aware of the fees that you're paying because they actually have a huge impact on your return. Let's start with chasing performance. Quite frankly, chasing performance is the most common strategy people employ when making investment decisions, but yet it's the worst thing that you could possibly do. I've done lots of research on this topic, mostly because I personally wanted to see if chasing performance actually works as a winning investment strategy. In my best-selling book, Mutual Fundamentals, I looked at mutual fund data from 1985 to 2006, and I wanted to see how often funds made it into the top 20 in their respective categories for 2 consecutive years in a row. In other words, how often did chasing performance actually work? Pick a fund out of the top 20 and you'd be in the top 20 the following year. My results showed that it happened about 14.7% of the time. Although these results surprised me, they were higher than I thought, the results are also saying that 85.3% of the time, chasing performance did not work. These are not good odds when it comes to becoming a successful investor. The problem with this analysis is back in 1985 there was only 300 funds to choose from, and in 2006 there was about 7,000 funds to choose from. To get in the top 20 in 2006 was a lot harder than getting into the top 20 in 1985. So, to make things fair, I wanted to see if you could pick above average funds based on past performance. By definition, above average means half the funds are above average and half the funds are below average. Again, the results suggested that chasing performance does not work. Only 2.7% of all funds were above average for 5 consecutive years in a row. That's crazy low. And less than 1% of all funds were above average for 7 consecutive years in a row. And only 1 single fund was able to be above average for 10 consecutive years in a row. The moral of the story is quite simple. Do not chase performance. It doesn't work. And if it were that simple, think about it. Investing would be a whole lot easier and more successful than it usually is. When it comes to investing, we go to great lengths to try and improve and enhance returns. What do you think is the most effective way to enhance returns? Stock selection, market timing, forecasting, research, getting advice, insider information, lowering your fees? Would it surprise you if I said that lowering fees is one of the most tangible and direct and easy ways to enhance your returns? Let me prove my point. All of the fees in the mutual fund industry are embedded. The fees on a retail mutual fund are about 2.5%. The problem is you never see it because you never pay for it directly. In this example, if your investment produced a 7.5% return, a 2.5% fee would leave you with a 5% net return. The industry is regulated so that all returns to the investor are shown in net returns, not gross returns. One of the advantages of a group plan is you typically get a break on fees because of the buying power of the group. So anytime you lower fees, it means a direct increase in the return to the investor. As you can see, a 1% reduction in fees means a 1% increase in net returns, and it's really that simple. That fee savings not only makes a difference over 1 year, but over time a fee savings can compound into a lot of money. As you can see from this chart, a 1% savings in fees over 25 years on a one-time investment of $10,000 means an extra $9,411 in the investor's pocket. That's 29% difference in accumulated values. Now that's significant. When choosing investments, it's important to be aware of fees, and the lower the fees, the better. Next, let's look at the difference between active and passive investing. Active investing is exactly what the word says. Active investments buy and sell to try and outperform the markets. It's the belief that research, analysis, timing, and selection can increase and enhance returns. But does anyone really have the edge in this kind of investing? Passive investments are the opposite of active investments in that they don't try and beat the markets, but instead they try and be the markets. Passive investments invest in the index. They're not fancy, and as a result, they have significantly lower fees. So, do active investments outperform passive ones? Does all the buying and selling based on research, timing, and intuition actually pay off? Unfortunately, the results for active investments are not good. These figures show the number of active investments that are able to beat the market. As you can see, for all asset classes and all time frames, passive investments win. Generally speaking, passive investments win 65 to 100% of the time. Passive investments win over active ones, but by how much? If you look at the difference between the average annualized returns of the index versus the average of all mutual funds, there's about a 1.08% difference over a 10-year rolling period. The compounding effect of 1% over 10 years is very significant. In fact, the data is consistent over different time frames. Here's the data for 5-year periods. So, when it comes to selecting investments, remember these research-based tips. Number 1, it's tough to beat the market, so look for passive investments. 2, lower fees gives you the edge. And 3, don't just chase performance. Remember that past performance is no indication of future performance. So there you have the basic steps to building a portfolio. The next step is to manage your portfolio. I'll teach you that in the next video. I hope you now understand that investing is not rocket science, even when it comes to building a portfolio. Just follow these 3 steps, and if you still need help, we have a team of professionals that can help you. Good luck!